This podcast is for information and entertainment purposes only. Nothing on this podcast should be construed as financial advice. All views expressed on this podcast are solely the opinions of the host and/or any guests that we might have from time to time. Nothing on this podcast should be construed as a specific inducement to make a particular investment or to follow a particular investing strategy.
Hello, you sexy sat stackers, and welcome to the latest episode of the Bitcoin Bulletin Podcast. I am Chris, and boy, do we have a lot to talk about. The U.S. economy remains perched on the brink. It appears that the banking crisis continues. So-called Bitcoin Jesus joins the latest list of targets in the then they fight you phase, and Bitcoin is on sale, which is absolutely perfect because, hey, it is DCA Wednesday, and we're going to grab a heck of a lot more Satoshis than we would if Bitcoin were a lot more expensive in US dollar terms. I'm not tooting my own horn here, and as usual, I like to remind you that nobody has a crystal ball, but I did say in several episodes leading up to the halving, but in particular in the final episode of the last Bitcoin halving epoch, I said of the things to expect was that after the halving, the price of Bitcoin would probably go down. Let's take a real quick rewind and listen into a few seconds from episode 158 on April 17th, just 2 days before the halving, where I discussed precisely this. So back to the halving. What should you expect? What is going to happen on April 19th or April 20th? Well, the first thing that's going to happen is TikTok next block. Bitcoin will continue to function exactly as before, exactly as always. Second thing is the price may go down. In fact, it probably will go down. In the past, it did just that. After the halving, the price actually retraced a little bit, and then it started coasting gently back up by the summertime. And it was something like a sell the news event. Okay, so I did cut a little bit out there between my point 1 and point 2 because I went on to talk about 2 minutes about how Bitcoin was going to become the hardest asset known to man and compared it to gold, and how when the price of gold goes up, more resources are expended to mine more gold, so the supply of gold actually increases, and how that doesn't happen with Bitcoin. But you get the point. I did tell you that Bitcoin tends to go down after the halving. It always has. So again, I don't pretend to have a crystal ball, but what I'm getting at here is nothing new is happening here. Bitcoin is behaving precisely like Bitcoin usually behaves. All right. We do have a lot to talk about, and we'll get into this a little bit more. But of course, before we do that, let's take our customary look at the vital statistics. At the time of this recording, we were sitting at a block height of 841,694. Of course, today is Wednesday, May 1st, 2024, and Bitcoin is ringing in at a US dollar value of 57,990. And that is, that's almost $7,000 less expensive than last DCA Wednesday. And because of that, we're going to get 1,724 sats for every dollar that we convert into Bitcoin. And that's almost 200 sats per dollar more than we got just last week. So that is really cool. I'm actually really looking forward to that. I've been dreading watching our average cost basis go up when we make these DCA Wednesday purchases. And it's going to go up today too, because even $57,000 is significantly more expensive than the $30,000-ish average cost basis that we have for all of our purchases combined. But I digress. As usual, I'm getting distracted and off topic here. So on with the vital statistics. We're a long way away from the next halving. In fact, we're 208,306 blocks away from the next halving. We haven't even had our post-halving bull run yet. But for those of you who don't know, you might be listening the first time, or this is maybe your first halving and you don't realize that the halving is a programmatic event that it happens every 210,000 blocks. There will be another halving at block 1,050,000, where the miner reward is cut in half again, and Bitcoin gets even harder and even more scarce. And that's looking like that's going to happen on March 16th of 2028. So for those of you who missed out on having a halving party or going to one of the big halving parties like the one in El Salvador, or the one in Berlin, or whichever halving party you had your heart set on, or you're feeling really left out that maybe you didn't get to go and you really wish you could, you have almost 4 years to plan to make sure you're in the right place at the right time for the next halving party. Of course, just like this halving, it probably will not happen on March 16th. It'll probably happen a little sooner than that. But, as we get a little bit closer to the halving, it'll be a little bit easier to predict within a day or two range if you're going to travel, especially if you're going to travel international, where you need to book that 6 months or more in advance. And we have a long time before we need to worry about that. But the point being, the halving that we just had is something that happens approximately every 4 years. Not really every 4 years. It happens every 210,000 blocks. And so TikTok next block, regardless of all the drama in the world, Bitcoin marches on. A new block is minted approximately every 10 minutes. And that miner reward gets reduced every 210,000 blocks until all 21 million Bitcoin are issued. And rinse and repeat. Bitcoin's current US dollar value gives it a market capitalization of $1.14 trillion, more than $100 million, fewer than last DCA Wednesday, but still significantly above that $1 trillion mark that I like to say was kind of the magic number for this cycle, that when Bitcoin became a $1 trillion asset, that people would start taking it more seriously again as a mainstream legitimate financial asset, financial tool. The traditional financial media, the normies, they like their nice round numbers, and $1 trillion puts Bitcoin firmly in the top 10 currencies of the world as far as market capitalization goes. We are below that market cap of silver, which was 1.319 trillion, and significantly below the $14 trillion market cap of gold. But that just shows you that we have a long way to go, that you're still really, really early, that with Bitcoin needing to basically 14x to get to the market capitalization of gold, something that I don't think is even, that's not even a moon for Bitcoin, in my opinion, that's just a stop on the way to hyper-Bitcoinization, that Bitcoin will become a heck of a lot more valuable than that. But even if it only becomes digital gold, even if it only becomes gold's twin, the electronic version of gold, then we still have almost 14x to go in price appreciation. And that is a significant chunk of change. So we're still early, although it feels less and less like it every day, especially, if you've had a full cycle under your belt. It's hard to conceive of, just how early we are still, because, your perspective changes when you get submerged in Bitcoin culture. If you're on Bitcoin Twitter every day and you're listening on Spaces, or you're listening to every podcast you can absorb, Bitcoin changes you, it changes your perspective, and it's really hard to remember what it was like for you when you first discovered Bitcoin. And so it's hard to keep that perspective, that even those of you who are just getting in today, you're still early. For those of you who value your wealth in that other form of gold, the physical form of gold, the shiny yellow rocks form of gold, the analog gold as we like to call it, it will currently cost you 25.3 ounces of gold to purchase just one Bitcoin. If you're a gold bug and you have been waiting to get into Bitcoin and you're planning on trading some of those gold coins, some of those Peter Schiff bucks for Bitcoin, it is your lucky day, because just a couple of weeks ago, we were talking about more than 2 pounds worth of gold to just purchase just one Bitcoin. And it's still going to cost you almost 2 pounds of gold to purchase one Bitcoin. By no means is it cheap, but they say you get Bitcoin at the price you deserve. And right now, Bitcoin is going to let you in for just 25.3 ounces of gold. And I've said numerous times that before this year is over, before the end of 2024, we're going to be talking about Bitcoin in terms of pounds of gold, not just 2 pounds of gold, like multiple pounds of gold, especially as gold trends to zero in Bitcoin terms. Bitcoin is volatile and gold's been relatively volatile too. So the prices have gone up and down and twisted around each other. And so, like everything with Bitcoin, if you zoom out though, you'll look at, when gold used to be significantly more valuable per ounce than one Bitcoin is, and that has gold lost its monetary advantage over Bitcoin in terms of US dollar value, and now it's significantly so. And that's just going to continue. So again, you get Bitcoin at the price you deserve if you're a gold bug. That price is currently 25.3 ounces of gold per Bitcoin. For those of you who value your wealth in pizza, one Bitcoin is going to purchase you 3,243 large pepperoni pizzas from Papa John's. That is one pizza a day for more than 8.5 years, almost 9 years. And that's more than 2 additional halvings, 2 more halving cycle bull runs from now. So as I have said in the last several episodes, I think we're getting to the Bitcoin pizza singularity, where you'll never be able to spend, if you have a whole Bitcoin, you'll never be able to spend it all on pizza, because the price of pizza will continue to trend to zero in Bitcoin terms. And, as you start spending that Bitcoin has its first bull run and you've spent, less than half of your Bitcoin and becomes more valuable. And so Bitcoin will purchase you even more pizzas and maybe 10 more years worth of pizzas. And then we get to the second bull run and maybe Bitcoin will purchase you 30 years of pizzas or 100 years of pizzas. And eventually you'll just never be able to spend all that Bitcoin on pizza, at least not feeding yourself. Maybe if you buy the whole restaurant or chain of restaurants, you might be able to find a way to spend that Bitcoin. But the point being, it's really cool when you look back on that first Bitcoin Pizza Day, which the anniversary is coming up here this month, when Laszlo purchased 2 large pepperoni pizzas from Papa John's for 10,000 Bitcoin. And pretty soon we'll be talking about 10,000 pizzas for just 1 Bitcoin. I guess that'll be kind of the official Bitcoin pizza flippening. All right. Getting back to the metrics, looking at Bitcoin's on-chain activity, that's still been a little bit crazy. It's still nowhere near, it's nowhere near as crazy as it was at the halving when the Rune shenanigans launched. That appears to have fizzled big time. But there are still, in Clark Moody's mempool, at least 78 blocks worth of transactions pending. And that is up from last week when there were 71 blocks worth of transactions in Clark Moody's mempool. And other mempools obviously show significantly more transactions pending in their mempools because it depends on what your mempool size is. If you use the default mempool size like Clark Moody does, you start purging transactions, lower cost transactions. If you have filters set up, for example, and you're purging all those spam transactions, those ordinals, those inscriptions, then it's going to show fewer transactions. But because we've been looking at Clark Moody's dashboard for the last 2.5 years, almost 3 years, I think it's, on Rabbit Hole Recap, Matt Odell likes to say that, Marty Bent likes to call it Clark Moody's teeny weeny mempool, and Matt Odell likes to chastise Marty Bent for even mentioning this statistic, just because it is excluding a bunch of transactions. But for the purposes of consistency, this is one of the metrics that I like to continue to discuss because it shows you just where we are compared to previous episodes, previous Wednesdays, previous DCA Wednesdays. Because of the amount of on-chain activity pending, Clark Moody's mempool fee estimator is recommending that if you're going to do an on-chain transaction and you need to guarantee that it's mined in the next block, you need to include a fee of at least 34 sats per VByte. And that's actually down significantly. That's only 10% of what they were recommending last week when it would have cost a fee of 295 sats per VByte to be mined in the next block. Along those lines, if you have a day to wait, Clark Moody's fee estimator is saying that a fee of just 16 sats per VByte will be mined within a day. And if you have several days to wait up to maybe a week, a fee of as cheap as 5 sats per VByte will eventually be mined. Again, if you are going to lowball your fee and hope you squeeze into a block for less than the immediate or the medium priority fees, make sure you know how to use replace by fee. That you're using a wallet that will allow you to do that, so that you can lowball your fee and then you can bump that fee up if the transaction is not getting mined fast enough to your liking. Mempool.space is telling a very similar story. There's a pretty big deviation between Clark Moody's fee estimator and Mempool.space's fee estimator, but today there's not. Mempool.space is saying that to guarantee that your Bitcoin on-chain transaction is mined in the next block, you should include a fee of at least 33 sats per VByte, so 1 sat per VByte cheaper than Clark Moody's fee estimator. And at current US dollar prices, that works out to about $2.68 for that transaction and mining fees. And that is less than half of last week when Mempool.space was saying a priority transaction would cost you $6.38. So fees are coming down, and most of that is because because Rune's fizzled, and we're seeing those ordinals inscriptions, the BRC20 tokens kind of wind down. Maybe not go away, but slow down. The hype is certainly faded. If you are making a medium, low, or no priority transaction, Mempool.space is currently recommending 31 sats per VByte for medium priority, 28 sats per VByte for low priority, and 10 sats per VByte for a no priority transaction, more than double the 5 sats per VByte that Clark Moody's fee estimator is recommending. So if you need to transact on chain and you need to do so right away, make sure you get the latest fee data, regardless of what source you're gleaning that from. And then, of course, hopefully use a wallet that'll let you replace that fee if it doesn't go through fast enough. That metric that has always been my favorite metric since we started this podcast, Bitcoin's 24-hour average transaction rate, is down significantly as well from last DCA Wednesday. Last Wednesday, there were an average of 7.12 transactions per second on chain, and right now, that average is down to 5.80 transactions per second. And once again, that is corresponding with a decrease in Bitcoin price. So again, this is just an anecdotal observation that I've made in the 160 episodes now that we've done where I've looked at this statistic. So not necessarily transaction analysis, which I think is voodoo, that again, nobody has a crystal ball, but it is interesting to note the correlation between transaction rates going up and coming back down and the price action of Bitcoin. We have not had another difficulty adjustment in terms of mining difficulties since last DCA Wednesday, because last Wednesday we'd had a difficulty adjustment only like 60 blocks prior. So that was a difficulty increase of 2%. We're currently 994 blocks away from the next mining difficulty adjustment. And that's going to be in about 7 days, approximately on May 8th. And now that's looking like that's going to be a difficulty decrease. Last DCA Wednesday, it was all over the place because only 60 blocks in, when you're talking an average, you don't really have a good data set for determining where we're going to be 2 weeks from now. Now it's getting a little better and the range is narrowing, and it's looking like we're going to have a difficulty decrease of anywhere between minus 1.58% and minus 3.2%. And that is because blocks are currently coming in at 10 minutes and 20 seconds. And of course, the Bitcoin Core protocol likes to shoot for, aim for an average of 10-minute block times. So when blocks are coming in slower than 10 minutes, it reduces the difficulty that it takes a miner to find the next block to try and speed that up. Last DCA Wednesday, the average was 7 minutes and 38 seconds, which is as fast as I've ever seen it. Again, that's because we were looking at a very small data set. So, I didn't expect that to be the case for very long. But since they were coming in faster, it was looking like you were going to have a huge difficulty increase. And that now is reversed as we're getting closer to that difficulty adjustment, and it comes a little bit more into focus. Of course, that only really matters to you if you're a miner, because, the block times are just an average. If they adjust the difficulty up or down to try and aim for 10 minutes, you could still see a 1 hour block, or you could see 2 blocks come in back to back almost. Again, it's a lot like flipping a coin. If you flip a coin 10 times, you might actually get heads 10 times in a row. It's odd, but it could happen. But if you flip a coin 2016 times, you're going to get 1,008 heads, 1,008 tails on average. And so that's why the difficulty is adjusted every 2016 blocks, to try and get a more reliable data set, or more reliable average of average transaction time, average block time. And right now that's 10 minutes and 20 seconds. So blocks are coming in a little bit too slow for Bitcoin's protocol for Bitcoin's appetite, the protocol's appetite. And that's why, if that continues, we'll see it get a little bit easier for you mining at home. You'll get a few more Satoshis a day with your miner that you're using to heat your house, or with your garage rig if you're mining at home. All right, before we get into the news, I want to take a minute to thank those of you listening on your favorite Podcasting 2.0 app, such as Fountain. Podcasting 2.0 allows you to support your favorite podcast through the value for value model, one of two ways. Either you can stream sats on a per minute basis while you're listening to your favorite podcasts, or, and this is the most popular and my favorite method, you can boost the podcast, which is basically sending a shout out, sending a message to your favorite podcast, but it's a Lightning transaction. So you're sending sats to help support those podcasts when you do so. And of course, when you do send a boost to the Bitcoin Bulletin Podcast, as long as it's nothing outrageous, and we've never had that be the case, we read those boosts on the forthcoming episode. So if you boost this episode and it isn't anything completely outlandish, we will read it on next Wednesday's episode of the Bitcoin Bulletin Podcast. Our geographic distribution of listeners has once again pretty much remained exactly the same. The percentages have changed just a tiny bit, but the country order has not. Our top 10 countries as far as listenership goes, number 1 remains the United States, and that makes sense because I'm in the United States. This is an English language podcast, so it would obviously make sense that it would appeal more to people that are sitting here in places like Florida listening. Number 2 remains Argentina, which I think is really cool because Argentina is one of those places where Bitcoin can be more helpful. If you're in the United States, the US dollar, it's been inflating. We've had inflation in this country, but nothing like countries like Argentina have experienced. So oftentimes it can be hard to orange pill your friends and family because they don't really see a need for a money that doesn't get debased. That's a hard currency that is not confiscatable, is uncensorable, immutable. And in other countries around the world that they've experienced hyperinflation, or their central bank has defaulted, or governments have seized their money, given them haircuts, etc. It's a lot easier for people. All they need to do is find out how to use Bitcoin. They don't need to be sold on the idea of a money that isn't going to be inflated away. So muchas gracias, amigos, in Argentina. It's flattering that is still the number 2 country as far as listener distribution goes. Number 3 remains Germany. So Dankeschön, mein Freunde in Deutschland. I have a soft spot in my heart for German Bitcoiners. I often say it looks like German Bitcoiners just have the most fun looking at the Bitcoin get-togethers and the Bitcoin meetups. Certainly a country that has a reasonably strong currency compared to other countries throughout the world. Using the euro, the Eurozone's currency it's fiat. It inflates just like all other fiats, but it's inflating slower than in many, many other countries' currencies. So it's not a country where you'd expect people to need Bitcoin as much as they need it in other countries, yet Bitcoiners in Germany just seem to get it. And not only do they get it, they just seem to have a lot of fun doing it. I really, really want to get to a meetup in Germany in the not too distant future. Hopefully before the next halving. It certainly looked like you guys had a lot of fun at the halving in Germany. So muchas gracias, Dankeschön, mein Freunde in Deutschland, for listening. Number 4, as usual, remains Luxembourg. So Morien, or also Dankeschön, guten Abend, mein Freunde in Luxembourg. Thank you for listening. Thank you for remaining the number 4 most popular location for our listeners. Number 5 remains Canada. So hello to our friends up north in Canada. Canada has some interesting things going down. Of course, they went completely sideways with the trucker protest and the banking confiscations, locking people out of the banking system. But now they're talking about, I heard, as much as a 76% capital gains tax, which is just draconian as all get out. So Canada, it used to be people looked at Canada with jealousy from places like the United States, that Canada was a peaceful, prosperous country. And we never thought Canada would be the place where they would crack down so hard on peaceful protesters, and where they would use the Canadian money, where they would use the banking system as a weapon to silence political dissent. But boy, we've seen the eyes opened in Canada. So thank you for those of you listening in Canada. I'm glad you have Bitcoin, because if you were part of that Canadian trucker protest, the Bitcoin protest, or the lockdown protest, the vaccine protest, the jab protest in Canada, and you had your bank account shut down, your credit cards canceled, your vehicle registrations suspended, you know how easy it is for the government to take everything away from you just with a couple of keystrokes onto the current system. And so Bitcoin is certainly a life raft. The importance of Bitcoin as a life raft is certainly apparent to our friends up in Canada. So thank you to all of you listening from Canada today. Number 6 remains Spain. So hola, muchas gracias, amigos in Spain. Number 7 remains Colombia. Again, hola, muchas gracias, amigos in Colombia. Number 8 remains Sweden. So hey to all of you listening in Sweden. Number 9 remains our cousins across the pond in the United Kingdom. So hello to all of you listening. Thank you to those of you listening in the United Kingdom. And number 10 remains Venezuela. Again, a country where you don't really have to explain to people why you would need a hard currency, a currency that's not going to be hyperinflated away overnight, and a currency that's harder, that's seizure resistant, that they can't take from you if you have your Bitcoin in self-custody. So that is absolutely flattering. So hola, muchas gracias, amigos in Venezuela. Thank you for listening hard enough, listening in enough numbers that you're the number 10 country as far as our distribution of listeners goes. And I see you lurking down there at number 11, Mexico. If you're listening in Mexico, you're really, really, really close to moving into the top 10. So thank you to those of you listening in Mexico. And if you round up a friend or family member and help orange pill them and turn them onto this podcast, maybe you can break into the top 10. that would be cool to see some shakeup. I mean, I really love all of you, regardless of where you're listening. I'm a big fan of every country in the top 10 and the wonderful people in all of those countries. But it is fun to see change from time to time. So if you're out there listening in a country that's not in the top 10, it doesn't take a whole lot for some of those countries, especially Mexico, which is just barely out of the top 10, to maybe move into the top 10 and help represent your country as far as our listenership goes. All right, on to the news. Of course, what everybody's talking about today, well, there's a lot that people are talking about today, but usually when the price is way up or the price is way down, that tends to lead the news. And of course, the price of Bitcoin, if you don't zoom out, if you're staring at the charts, is way down today. Of course, if you remember before the Bitcoin ETFs launched, when I said if history repeats, that we should be looking at a price of $45,000 to $48,000 on halving day, we're still way above that. So as far as Bitcoin being down, Bitcoin is actually up at this point in time compared to history for where we are in this new halving epoch, in this new halving cycle. Either way, though, we're nowhere near as high as we were when Bitcoin set that new all-time high at around $73,500, depending on where you get your data. And there's a lot of reasons that people attribute to this for why Bitcoin's price is down. And again, nobody really knows. In general, I think a lot of it is just the whole euphoria, the hype of the Bitcoin ETFs pumped us a lot sooner, a lot higher, a lot faster than the halving itself would have. And so some of that shine is maybe wearing off. Some of it is attributed to the general economic worries. We've had a lot of bad economic news recently in the United States and around the world. Some attribute it to maybe a lack of certainty over what the Fed is going to do with interest rates. We just had the Fed announce that they were holding interest rates level in the United States, which is kind of what they expected, but we'll get into that story a little more in just a few minutes. But the Fed has sowed some doubt, or maybe people trying to second guess the Fed. They've come to sow doubt the financial talking heads, the traditional financial media, trying to figure out when interest rates are going to come back down, because interest rates are a lot higher than when there was that free money, that easy money out there, the almost 0% interest rates in the United States for big borrowers. But in the grand scheme of things, our interest rates in the 5.25% range are pretty darn cheap, considering I've seen them a lot higher in my lifetime. And I'm certainly not a boomer. I didn't have an 18 or 20% mortgage in the 1980s like the boomers did. But I also remember a time when mortgages were above 7, 8, 9, 10% routinely, and you could earn 4 or 5% interest on your savings account at the bank. So I guess maybe the 0% interest rates kind of became the new normal after the great financial crisis in 2008. But in reality, they're not the norm when you look at history in general, whether you're talking about fiat or even on a gold standard. Interest rates were a lot higher. Nobody was going to give you money to use and risk losing it, risk you not paying them back for free. That was an oddity. But while fiat is while we're still in a fiat economy, I wouldn't be surprised. Anything goes, and they're desperate attempts to maintain control of the system, especially as the debt spirals out of control in the United States, and inflation continues to ravage the United States. Even though, again, it's nowhere near as bad as it is in many countries, it definitely is a shock in the United States to have high inflation. But remember, basically, as I said, Bitcoin wouldn't be anywhere near all-time high territory this early in the new halving epoch. This is something new. This is truly, at this time, is a different thing. And it is entirely possible, in fact, highly likely, that Bitcoin's just losing some of the price exuberance that we saw from the approval of the Bitcoin ETF, the Bitcoin ETFs, the ETF launch, all of the hype about the institutional money, the Wall Street money, the dumb money, the traditional financial investment money, the retirement plans, the 401ks, the IRAs coming into Bitcoin. And so, who knows? All I know is that if Bitcoin behaves like Bitcoin always has in the past, or even close, if history doesn't repeat but even rhymes, the bull run, it hasn't even started. That, come next fall, next November, December, maybe around Thanksgiving, coming up in Christmas, that's when we're going to see real face melting. And maybe it happens sooner, but I wouldn't be surprised if we kind of go sideways for a while or up, slowly back up. Maybe we creep back up to that all-time high that we had set, sometime over the summer, June, July, August. Who knows? And you shouldn't even be really worried about that. What you should be doing is thanking your lucky stars that we're not trying to stack Satoshis today at $75,000 or $80,000 a Bitcoin. So again, zoom out, keep that long-term perspective. Bitcoin is just doing what Bitcoin does. Of course, as I mentioned in the lead in, Bitcoin has declined after the halving in the past. So Bitcoin isn't dying by any means. Even during the height of the face-melting bull run, Bitcoin has an average of 5 to 7, 30% pullbacks. It always has. So even if it weren't the ETF hype wearing off, or even if there weren't a black swan event or bad economic news or whatever you want to blame the price pullback on, these retracements are normal. They're healthy. It's just Bitcoin being Bitcoin. Dr. Jeff Ross, who is at Valeshire Cap on Twitter, pointed this out today when he basically retweeted a post that he had posted on April 17th, which was before the halving. It was actually the last DCA Wednesday, where he said that $73,679 intraday high on March 13th, 2024. 10% drawdown would bring it to 66,300. A 20% drawdown would bring it to 58,943. A 30% drawdown would bring it to 51,575. And that he forecast that we would have possibly up to a 40% drawdown, which we haven't even seen yet. And again, he doesn't have a crystal ball. He was just saying that these are as his tweet says, these possibilities are within the normal limits for this part of the Bitcoin price cycle, based upon my studies of past cycle behavior. So Dr. Jeff Ross is fun to listen to on Twitter Spaces, and he's fun to follow on Twitter. If you're not following him, he is at Valeshire Capital on Twitter or X. And he pointed out, as did I before this drawdown happened, that these drawdowns are normal and that you should perhaps even expect it. All right, on to the Federal Reserve. Of course, the Federal Reserve had their big rate meeting announcement today, and they left rates unchanged at that meeting. And that, of course, is exactly what everybody expected. Even a month or so ago, when people were predicting that the Fed would start cutting rates, they were saying they would cut rates in June or July, or maybe in September in the fall. What is different, though, is that Jerome Powell stated that those rates might not be coming down as soon as people are anticipating. And he didn't rule out interest rate cuts in the future, but he did urge caution. Yahoo Finance led the headline. Fed holds interest rates at 23-year high, citing lack of further progress on inflation. In a policy statement, Fed officials said in recent months there has been a lack of further progress towards the committee's 2% inflation objective. Officials reiterated more clarity in the outlook for inflation returning to target will be needed before cutting rates, saying, quote, the committee does not expect it will be appropriate to reduce rates to the target range until it has gained greater confidence that inflation is moving substantially or sustainably towards 2%, the statement read. For many, that was pouring gasoline on the FUD fire. Lynn Alden tweeted out a gif from Breaking Bad where Walter White basically torches, I think the guy's name is Ken. He has the customized license plates that Ken wins, and kind of a schmuck. He gets under Walter White's skin, so he sees him parked at a gas station, and he rigs the battery to make the car go boom. And so she posted a gif of him walking away from the car as it torches, as her response to the Fed's news, retweeting a tweet from Financial Juice, who I actually don't follow. I'm not super familiar with that account, saying, Fed's Powell, I am less confident than before that 2024 inflation will ease. Well, no shit, Sherlock. The Fed outlook, of course, was based on inflation data that was released last week to the public. I'm sure the Fed had access to that data for much longer than we did. Yahoo Finance on Friday read the headline, New inflation reading reinforces Fed's higher for longer stance. Another hot inflation reading reinforces that any near-term interest rate cuts are less likely as the Federal Reserve shifts to a higher for longer stance. The Fed's preferred inflation measure, the Core Personal Consumption Expenditures Index, that excludes volatile food and energy prices, the things that you don't have to buy, clocked in at 2.8% year over year for the month of March. That was the same level as February, but 0.1% higher than expected. Month over month, the measure of inflation rose 0.3%, which was in line with expectations. Today's data means that it will take a longer string of months of good inflation data before the Fed will be comfortable with cutting, said Preston Caldwell, chief U.S. economist at Morningstar. And then he goes on to market voodoo and predictions, whether or when the Fed's going to cut rates, because everyone's expecting the Fed pivot and they're expecting to go back to easy money, more quantitative easing, more QE. But, I've said multiple times that this feels a heck of a lot like the 1970s. I'm not a boomer. I was just a kid in the 1970s, but I remember the 70s. I remember Jimmy Carter on television. I remember the misery index. I remember stagflation. I remember waiting in line in the backseat of my parents' car for gasoline when we were running out of gas. I just remember a lot of things that feel very similar. And in the 1970s, we had runaway inflation, and then inflation started to cool, right? And it was under control, but it wasn't. Inflation went back up and it kind of roller coastered up and down for 10 years. And it wasn't until the Reagan years in the 1980s when Volcker came in and jacked interest rates through the roof, significantly higher than they are now, that inflation finally curtailed. And one of the things that I think we're finally seeing the end of is, this has been a pet peeve of mine, especially on podcasts where they say things like, it's not the party of red or the party of blue, it's the party of orange. And I get what they're saying. Bitcoin is for everybody. But in general, in the United States, the party of blue, the Democrats, are leftists. They're socialists or worse. And you can think that's fine. You can be a socialist, you can be a leftist. But the whole thing, if you're a socialist or a leftist, is that you have to have central control over the economy. And central control over the economy and manipulating the currency is the antithesis of Bitcoin. So it's a no-brainer that we're seeing Democrats line up against Bitcoin, that we're seeing the Biden administration being hostile to Bitcoin, coming after Bitcoiners, coming after Bitcoin adjacent projects, trying to make it as difficult as possible for Bitcoiners, or as difficult as they can. And I think with the events that we've seen this week that we'll get into in a minute, I think people are starting to wake up and realize that. But it should be a no-brainer. And I'm not saying that you can't be a socialist. Maybe you are, and you think that that's the right thing to do, and you're a caring individual, and you have your reasons for why you think that there should be taxes, wealth should be confiscated and redistributed. I'm not arguing whether that is good or not. I personally disagree with you. But my point is, if that is your worldview, if that is your government view, if that is the paradigm that you're operating under, a free money that the government can't just take from you, that they can't inflate to pay for programs, is a real problem for that form of government. All right, I'm getting ahead of myself again. I just want to get back to the Fed once again, because this whole inflation thing and raising interest rates to get inflation under control is all smoke and mirrors anyway. Because remember, the reason we're in this predicament in the first place is because they're printing money like it's going out of style. They're increasing the supply of money in the system, and by doing so, they're decreasing the value of that money. It's simple supply and demand. It's kindergarten, grade school economics. Everybody understands that you have a lot of something, it's worth less than if it's scarce. Bitcoiners should certainly understand that. So all of that is BS in the first place. But the way the Fed is looking at this is that they're raising interest rates to get inflation under control by wanting to, quote unquote, cool the economy. And what that means is they want to put people out of work. They want to slow economic growth. They want to make you poorer to make up for the fact that they printed too much money, so that prices will not go up as fast because you won't be able to afford to buy anything. And that's another, aspect of supply and demand. If there's no freaking demand, then obviously that affects prices as well. So instead of curtailing the overinflated supply of U.S. money, of U.S. currency, of the U.S. dollar, they want to kill demand. And they want to kill demand by putting you and your family out of work, by making you homeless. And that's just effed up, man. That's just screwed up. And that's one of the things that Bitcoin fixes. And that's one of the biggest reasons that I'm a Bitcoiner. I mentioned earlier that this whole thing has a feel of the 1970s, that it was during the 1970s that we had the term stagflation. It's the first time I ever heard the term stagflation. And we had inflation at the same time we had a contracting economy, which is what it's looking like we're ending up with now, because we have a slowing economy, even with the job statistics that they put out, that they've massaged to make it look like our economy is growing. Even by their measure, it's growing in a less than ideal manner. Growing slower than it should be. And you couple that with inflation and you have stagflation. You combine that with all the horse crap that's going on in the world. We have conflict in the Middle East, just so many of the same issues that we had in the 1970s. It really does feel like deja vu. And so now we're looking at facing stagflation. Fox News, I think it was Fox Business, ran the headline, "Stagflation fears come back with a vengeance." Some Wall Street strategists are growing concerned the U.S. economy could be headed toward a 1970s-style stagflation scenario amid recent signs of stubbornly high inflation and a cooling economy. I have been telling you this for at least a year, if not the entire history of the Bitcoin Bulletin podcast. When they first started raising interest rates, and I played the quote from I'm having a Joe Biden moment where the movie where the don't dance, the Ben Rickert movie where the Big Short, where they're talking about what happens for every 1% or whatever GDP declines, 10,000 people die or whatever. I'm going off on a major tangent, but the point being, I've been harping on the fact that we're experiencing stagflation already. The fact that they had to change the definition of what a recession was, if they hadn't already done that, the government, massaging what it means to be in a recession, that we'd already officially be in stagflation because we have persistent sticky inflation and a contracting economy. So, if you've listened to this podcast, you heard me talk about stagflation and a repeat of the 1970s. So this shouldn't be news to you, but it's apparently news to Wall Street, and outlets like Fox News, Fox Business are now starting to float the term stagflation and predict that we're heading into a 1970s style scenario. More companies have been reporting plunging sales and losses. So despite the fact you hear that the economy is absolutely rosy, this has been a bad quarter for lots of businesses in the U.S. And the latest to report crappy earnings was Starbucks. And Starbucks, I think, is a bellwether because it's kind of a luxury thing in the United States. People don't necessarily think of it as luxury, going and getting their $7 coffee every morning. But it's not a necessity. You don't need your $7 coffee to live. Some might argue that you do. But it's a luxury good, but it's not a luxury good like a Rolex or a Lamborghini. It's a more common pedestrian luxury item, but it's discretionary spending any way you slice it. So when Starbucks stock plunges because they're missing their sales goals, because their revenue is declining, that should be a big red warning flag that if the average Joe is cutting back on their one little thing that makes them happy. I'm not a big coffee drinker. When I do drink coffee, I want something a little nicer than Starbucks. As you know, when I had Good Beans on from El Salvador, I like to order my coffee from El Salvador now because it's, quite frankly, the best coffee I've ever tasted. But I drink coffee sparingly, and so when I do, I like to have nice coffee. And quite frankly, ordering coffee from El Salvador is way cheaper than going to Starbucks. Another big tangent here, but my point being, Yahoo Finance is running the headline. Starbucks stock plunges 14% after badly missing its Q2 earnings estimate. The glass is looking half empty for Starbucks this quarter. For its second quarter earnings, the company missed expectations across the board, posting lower than expected revenue, earnings, and same-store sales growth as customers pulled back on the frequency of their visits and the size of their orders. This is not a sign of a healthy economy. When people are cutting back on that cup of coffee that many people would previously have considered mandatory, they can't get through their day without their coffee if you're a coffee person. When you're cutting back on coffee, it is because you are feeling the pinch, because the economy is not rosy. And that should be concerning. That should be very concerning. It's one thing if PayPal lays off, employees. It's another thing if Tesla misses their sales goals because, Teslas aren't super mainstream, and those are certainly a luxury item, regardless of how you feel about green energy transition. Buying a $40,000, $50,000, $60,000 electric car is not an everyday purchase like a cup of coffee is. So when Starbucks misses big, that should be setting off warning bells. Speaking of warning bells, this is also something we've spoken about. When we had the Silicon Valley Bank failures and all the bank failures before they stepped in with their credit facility to help prop up these banks and temporarily stem the bank failures, myself and many other people pointed out that in the 2008 financial crisis, we had the initial bank failures, and then we had a period where all was calm, and then it just hit the fan, when they had the big finale collapse months and months later. And I said, just because the bank failures appear to be under control, that doesn't mean we're out of the woods yet, because last time that's what happened. We had a lull, everything seemed fine, and then we had the big financial collapse, the Great Recession, months and months and months later. And that might be a case of history repeating itself, because under the headline, bank failures continue. Oh, where did I get this headline? Fox Business ran the headline, Republic First seizure signals more bank failures to come, experts warn. Fears of contagion reignited by first U.S. bank failure 2024. Republic First Bank, a regional lender based out of Philadelphia, became the first bank failure of 2024 on Wednesday when it was shut down by Pennsylvania's bank regulator, and the Federal Deposit Insurance Corp seized control of the operation. Now, I'm getting away from the article here. As is typical of the FDIC, et cetera, when a bank fails, they shut the doors on a Friday night, made arrangements for the bank to reopen as a different bank on Monday morning, so as to prevent panic, to prevent bank runs, because the average customer isn't going to notice anything happened. But this is a big deal. This means that that the banks are still weak, that the banks are still exposed to things like the commercial real estate crisis. They're still burdened by these U.S. treasuries that they've been forced to hold, that they're required to hold, that are technically an unrealized they're an unrealized loss if they're forced to sell those treasuries to cover deposits. They're all insolvent, and I think I don't want to see a doomsday scenario unfold and people get hurt, but we are standing on the head of a needle. We're on the precipice here in the United States still. I'm not saying the banks are going to fail, but this is not a good omen. This is not a good harbinger. And the media is starting to notice that with the failure of Republic First on Friday. And hopefully Republic First will only be the first and will also be the last. But I wouldn't hold my breath. Speaking of banks and monetary policy, over the weekend, it became apparent that the Japanese yen was collapsing and that it appeared that the Bank of Japan was dumping U.S. treasuries to try and prop up the yen. And Bloomberg ran the headline, BOJ accounts suggest Japan intervened Monday to support the yen. Japan likely conducted its first currency intervention since 2022 to prop up the yen on Monday, according to a Bloomberg analysis of central bank accounts. This is a big deal because obviously the United States spends a ton more money than we take in. We're running massive, massive deficits. And the way we can do that is they print treasuries and they sell them to countries such as Japan, who have been the single largest foreign buyer of U.S. treasuries. If they're dumping treasuries to prop up their own currency, well, if you're dumping, you're not buying. And if you're not buying U.S. treasuries, the U.S. government is going to have trouble selling treasuries. If they're having trouble selling treasuries, that puts the U.S. government in a really, really precarious position. And in and of itself, it is not necessarily the end of the world, but it's just one more thing in this steaming pile of horse dung that we have in the current economic situation in not just the United States, but in the world. Of course, I'm talking specifically about the U.S. here and the U.S. treasuries. But if the U.S. government tanks, if the U.S. dollar tanks, the rest of the world's coming along for a ride. I think that's pretty obvious to everybody because, in countries where you don't have a strong currency, you'll usually see people using the U.S. dollar. Now they're starting to use stablecoins and Bitcoin and other crypto, hopefully moving more and more to using Bitcoin as they learn more about Bitcoin, as Bitcoin becomes more mainstream. But the point being, the world relies on these petrodollars, on these U.S. dollars, as a bellwether. So goes the U.S., goes the rest of the world. And this is just one more thing, but it's a thing in a long line of things that are all starting to add up, that are all pointing towards, thank God you have Bitcoin, because that's going to be your life raft. And I'm not trying to be a doomer here because we all kind of knew this was going to happen. That's why we're Bitcoiners, right? And in the end, in the long run, this is one of those, it's good for Bitcoin things. But even if it's good for Bitcoin, even if we watch the value of our Satoshis go through the roof, we don't want to do it by watching our friends and family lose their homes and starving on the streets. So, be afraid, right? I don't have a crystal ball about the price of Bitcoin, and I don't have a crystal ball about the state of the U.S. economy, but we know that eventually all fiat currencies collapse. And the U.S. fiat dollar, the fiat currency, the non-gold backed dollar has been, it's lived longer than the average fiat currency does. Part of that because, the US dollar is the big boy on the block and a lot of other currencies have to fail first, but a lot of other currencies are failing first. I, take you back to the article about the yen, the BOJ needing to prop up the yen. it may be the dollar milkshake theory where everything's going to get sucked into the US dollar, but after that milkshake's empty, the milkshake gets thrown away as well. All right. The icing on the cake is if it isn't bad enough, if it isn't authoritarian enough, if the government isn't ridiculous enough, the Biden administration's new budget proposal it's horrible in many, many ways as far as its tax increases, et cetera. But again, in this headline from Fox News, Biden's capital gains tax proposal would crush the economy, experts say. President Biden's latest proposal to hike the top capital gains tax rate to its highest level in more than a century is facing heavy criticism from experts who warn such an action could significantly harm the U.S. economy. This is a big deal for multiple reasons because you cannot tax yourself rich. I have a huge problem with taxation in general. It's gotten way out of hand. But things like property tax and capital gains tax, I have a problem times 12 because capital gains tax is money that you've already been taxed on, that you've invested to try and help preserve some of your wealth, to help compensate for the fact that they're purposely inflating the value of the money there to inflate away your savings, to continue to steal from you. And that if you happen to make a few dollars, you're not actually making a few dollars. All you're doing, for example, if you bought a house and the price of your house doubled over the last couple of years, it's not that you really made a profit on your house. It's the fact that housing got expensive because of inflation. And the same thing goes with your stocks, your bonds, and to some extent with Bitcoin. Some of the appreciation in Bitcoin's value is because you're measuring it in US dollars, or you're measuring it in pesos, or you're measuring it in the euro, and the value of the euro is going down. So you haven't really made a gain. For example, let's talk about the McDonald's Big Mac. In the 1970s, when the McDonald's Big Mac was 69 cents, it was one Big Mac. It was still one meal. And now that the Big Mac is more than $10 in several places, it's still just one Big Mac. It's still the same price as a Subway sandwich. It would still only buy maybe a couple gallons of gas or whatever that money would buy. But if you bought that Big Mac as an investment in 1970 and want to sell it now, the government would try and say you made a profit on that Big Mac and that you owe capital gains taxes on $10 worth of profits. And that's just insane because you only still have a Big Mac. You didn't make a profit. The value of the dollar collapsed to the extent that it looks like the Big Mac is more valuable, but it's not. It just takes more US dollars to buy the same Big Mac. So when they want to steal from you because the value of the Big Mac went up because the Big Mac got more expensive, I think that is farcical. And now they want to steal even more from you, raising that interest rate, that capital gains tax rate, to 44.6%, almost half of the gains. So let's look at that Big Mac. If you bought a Big Mac in 1970 for 69 cents and you sold it today for $10, we'll round it from $1 to $10. You have $9 of the capital gains. They want almost half of that. So they want you to pay $4 in taxes because it takes more dollars to buy a Big Mac. And for those of you listening in Canada, and apparently there are many of you doing so, because we just went over the fact that you're in the top 10 countries for listenership, their capital gains tax, they're talking about raising to as much as 75% or more. So you can understand why that would have a big impact on the economy, because if you are going to invest your money and you're going to try and save for the future, and the government's going to take half of it, not half of the value of your savings account, but half of the profit, half of the gains that you made trying to keep up with inflation, that's really all they are. If they're going to take half of the value of inflation of your savings, well, it's just not worth saving. Nobody's going to take $1 they could spend today and put it away and not use it to buy something that they feel like they need or something that they really want, if they know the government's just going to take it from them if they try and hold on to it. And so, that's just one more bad omen, one more harbinger for why the dollar is doomed sooner rather than later, it looks like. Thank God for Bitcoin. All right, on to the Then They Fight You continues. Last week, we spoke about the government cracking down on Samurai Wallet, accusing them of money laundering. Then on Friday, these crackdowns resulted in Phoenix Wallet joining the list of many wallets and services that no longer let U.S. customers use their services. No BS Bitcoin on Friday ran an article entitled "Phoenix Wallet to Stop Serving U.S. Customers on May 3rd." Phoenix Wallet users in the United States are encouraged to close their channels and empty their wallets prior to May 3rd, 2024, with Phoenix Wallet saying on May 3rd, 2024, Phoenix Wallet will be removed from U.S. app stores, announced the project. Recent announcements from U.S. authorities cast a doubt on whether self-custodial wallet providers, Lightning service providers, or even Lightning nodes could be considered money service businesses and regulated as such. We are removing Phoenix Wallet from U.S. app stores and will be assessing other potential impacts to our operations, said ACINQ, the developer behind the Phoenix Wallet. Everybody knows the government can't stop Bitcoin. Everybody thought that maybe the government was acquiescing and realizing that they had lost, that now that BlackRock's in on Bitcoin, that there's going to be enough political influence that people that are big money, big influence peddlers will tell the politicians, not only jump, but how high, and tell them to back off on Bitcoin because, they're making millions of dollars, billions of dollars in BlackRock's case on Bitcoin now with their ETF. And I've always said I wouldn't be lulled into that self, I wouldn't be lulled into a false sense of security, because it doesn't matter how much political pressure you're getting from rich, wealthy customers, supporters, donors, companies that contribute to your campaign. If the very existence of your political career, of your entire life, because we're talking career politicians here, some of them have been politicians longer than we've been alive. Joe Biden, for example, having been a politician since the 1970 or 1971, the entire history of the fiat dollar, he's been in politics. And if his source of power comes from being able to print money, being able to devalue money, being able to tax you at will, being able to redistribute money and give money to people that he knows give your money to people he knows they're going to vote for him to get reelected, Bitcoin is a threat to that. And it doesn't matter if your supporters, if your donors get really, really angry and say, hey, back off on Bitcoin, if it's going to put you out of business. If it's like, hey, lose re-election or back off of Bitcoin, they're not gonna, or back off Bitcoin or lose the election. They're gonna want to get reelected. I got that backwards. I'm getting tongue tied here, but you get my point. They have a vested interest in cracking down on Bitcoin. They know they can't stop it, so they make it really inconvenient to use, as far as the draconian capital gains tax and tax reporting that they make you do every time you use Bitcoin. If you sell Bitcoin or buy something with Bitcoin, you have to track your capital gains and losses and file, report that on your income taxes. They're cracking down on, privacy tools such as Samurai Wallet. They're cracking down on wallet providers, calling them money transmission services, trying to claim that even a USB drive, as they claimed in court, can be a money transmitter, even though it doesn't actually have custody of the funds. So even non-custodial services, they're trying to say, are money transmission, money service businesses. And the reason they're making that is because then that gives them authority to arrest people and seize assets and put them in jail. They're not hoping that you'll get a license to do this. They're literally trying to say, you cannot do this. We're making it impossible for you to provide those services to make it harder for you to use Bitcoin. And they think that they can't make Bitcoin go away, but they can make it more inconvenient, that it becomes less of a threat to the US dollar, less of a threat to their system. Stephen Livera tweeted Monday, I guess, April 29th, about this. Kind of an amusing tweet. He tweeted, use this one weird trick to know if you're a money transmitter. Lots of people are so confused lately and unsure if they can operate in the US. Here's one simple trick they don't want you to know. If the US government doesn't like you, you're a money transmitter. And that's the crux of it. The argument is farcical that a non-custodial wallet can be a money service transmitter, a money service business, that a non-custodial, even mixer, if they don't take custody of the funds, is actually transmitting money. They're just a software writer, and you use the software to use as you see fit. But by stretching the law to put these businesses out of business, to make a few arrests, make examples out of companies or developers, they're hoping it'll have a chilling effect, that it'll scare people out of the market. And it's worked, because first we saw Wallet of Satoshi pull out of the United States a month or so ago, and now we're seeing Phoenix Wallet doing the same thing. And they flat out tell you that it's because U.S. authorities cast a doubt on basically whether or not they're going to get arrested for letting you use a Lightning node or a Lightning wallet. All right. So what has actually seemed to generate the biggest reaction, at least on Bitcoin Twitter this week, other than the price? Of course, I'm sure you already know, yesterday, former Bitcoin Jesus Roger Ver, and I think he actually hung that moniker on himself, if I recall properly, has been arrested while he was in Spain on tax evasion charges, awaiting extradition to the United States. Reuters ran the headline last night. I think it was 6 or 7 o'clock in the evening, Florida time. Bitcoin Jesus arrested in Spain on U.S. tax evasion charges. An early investor in Bitcoins dubbed the Bitcoin Jesus has been arrested in Spain on U.S. charges that he evaded paying at least $48 million in taxes, the U.S. Department of Justice said on Monday. Roger Ver, 45, was charged with mail fraud and tax evasion in an indictment filed in the federal court in Los Angeles that was unsealed following his arrest in Spain during the weekend, the department said. Okay, so if you've been in Bitcoin for any length of time, especially if you're an OG, you know that this isn't Roger Ver's first brush with U.S. law enforcement. In 2002, well before Bitcoin existed, Roger Ver pled guilty in federal court to charges related to allegedly selling explosives on eBay and shipping them via the post office. Oops. I think he served 10 months in a federal prison. Then he later left the United States, subsequently renounced his citizenship, and this is what this all stems from. And this is where the opinion is mostly split. In the United States, when you leave the country, if you give up your U.S. citizenship, you're still subject to the so-called exit tax. And that's basically they look at your net worth, your unrealized gains. Even though you haven't sold Bitcoin in this case, they say you've got Bitcoin, you've made a certain theoretical unrealized profit on that Bitcoin, and you owe us capital gains tax. You owe us taxes on that as part of getting rid of your citizenship. So Bitcoin Twitter is largely split between people who are happy to see Ver go to prison because he's a hated figure because he did go to war with Bitcoin and he was a Bcasher, and for the longest time he ran Bitcoin.com and tried to trick people into buying BTC or trying to buy Bcash. If you clicked on buy Bitcoin, you actually ended up buying Bitcoin Cash. So people are split on it, and you have people, for example, Peter McCormick, who, this is surprising because I'm not a big Peter McCormick fan. I think he's a statist cuck. He's always the what about my roads kind of thing, and so and the way he's spent his Bitcoin wealth buying fancy cars and football clubs, etc. I mean, that's cool. Do what you want with your money, but I question whether he's in it for the personal gains or whether he's truly a Bitcoiner, especially since he feigns stupid. Maybe he's trying to be the Joe Rogan of Bitcoin, where he's open-minded and pretends like he doesn't know the, oh, really, tell me more kind of thing. But he's certainly been anti-freedom as far as Americans see it. He's definitely an anti-gun. He's very pro-tax. You should pay your, render to Caesar what is Caesar's so they can build the roads, the hospitals. He's more of a socialist than anybody else I know personally in the United States anyway. But even Peter McCormick tweeted today, I've reached the tax is theft phase. Sorry it took so long. So if a statist cuck is standing up for Roger Ver, you've got a problem. You have a popularity problem. Dan Held, another Bitcoin OG, tweeted, breaking, Roger Ver charged with mail fraud, tax evasion, and filing false tax returns, blah, blah, blah. They tweeted the headline, tweets, good, he's been a net negative for Bitcoin. And that seems to be the other flip of the coin, where people are so happy to see Roger Ver get, what he has coming. They're so happy to see the whole time wounds all heals, karma coming back to get him for being such a schmuck, that they don't care that the government is being abusive and heavy-handed and perhaps in going after him. And so the good, he's been a net negative for Bitcoin, seems to be the other half of the spectrum. Of course, Bitcoin OG Adam Meister, as usual, has his own unique beast to take on the situation, tweeting today, Roger really sold tons of Bitcoin in 2017. Now we get a better grasp of how many BTC he really owned and how Bcash deranged he became. He didn't just talk the talk. Horrible financial move on his part, but there's no good reason for the USA to go after him. I support him on this. If he lied on his income tax and he broke the law, that was incredibly stupid because he's going to spend a lot of time in prison for it. There's probably more to this story, and who knows. I have a major problem with the exit tax because the United States is one of only 2 countries in the world that reaches out and taxes you after you leave the country. And to tax you on unrealized gains means you have to sell everything you own, because if you owe half of it in taxes, if you don't have enough cash, you probably don't. You have to liquidate your assets. That's just mean. That's just vindictive. The government clearly doesn't need the money because they're just going to print it anyway. I already have a problem with the capital gains tax. An unrealized capital gains tax is even more assholic, in my personal opinion. All right, on to a little bit more happy news. This is a Bitcoin fixes this kind of headline. It doesn't seem that way at first. The headline seems doomer. Bloomberg ran the headline, Texas power prices signal grid stress in another long, hot summer. A surge in Texas power prices for August suggests another summer of heavy electricity demand and potential grid strain to meet air conditioning needs. Traders start looking at prices months in advance to gauge the outlook for demand. Already in mid-April, August power prices for Dallas soared to $168.70 a megawatt hour, which was the highest level in 5 years for this time of year, according to Bloomberg Fair Value data. Prices were still hovering around that level on Friday, an 82% premium versus a year earlier. What this article doesn't mention is that Bitcoin has already fixed this for the state of Texas. We've spoken about this on this podcast, and I'm sure you've heard other podcasts talk about how Bitcoin miners in Texas are balancing the grid, that they're allowing the grid to produce a fixed load of electricity, more so than the customers need, and that when there are times of heavy demand, the miners agree to shut off so that electricity can be used by homes and businesses instead of used to mine Bitcoin. And as a result, we had a really cold winter in Texas. We had several instances since this has gone into effect. We had a hot summer last year, and we had a cold winter this year where the Bitcoin miners shut down for a week or a few days at a time, and that prevented these blackouts, that prevented these brownouts. There were still anti-Bitcoiners in Texas who tried to get who tried to demonize Bitcoin and tried to make it look like Bitcoiners were screwing the taxpayer over, and that they tried to make it illegal and ban these load balancing agreements. Unfortunately, I don't think that's ever gone anywhere, because quite frankly, what's going to happen is it's going to get hot in the summer, because that's what it does in the summer in the United States. And people turn their air conditioners on, and there's more demand for electricity, and it strains the grid. And Riot and the other Bitcoin miners in Texas are going to scale their mining production back. They're going to turn many of their miners off, and the electricity that people need is then going to be available for the air conditioning units, etc. And we've already seen that be a huge success, at least twice so far in the last year. And so that's an example of Bitcoin fixes this. And even if we don't have enough capacity that they're going to be able to avoid brownouts this summer, if it is particularly long and hot summer, that just means we need more of this, that this is something that Bitcoin can fix. And it shows that there should be more Bitcoining mining in Texas so that they can bring more electricity on demand online, so that when there's more demand, it's there, it's available. Because unfortunately with electricity, you don't just turn a dial up at the power plant. You need to be producing kind of a base load. And a lot of times electricity gets wasted, and then you don't want to produce too much excess capacity that you'll never need, because it's just going into the ground. It's being wasted, truly wasted. And so by the Bitcoin miners using as much electricity as the state of Texas can produce, when it's not in demand, that allows the power generation to be profitable, to make this excess electricity, to not lose money in doing so. And in Texas, mind you, even though it's a big oil state, a lot of this is green energy. If you've ever driven across Texas, it's miles and miles and miles of windmills and solar panels. So a lot of this a heavy portion of it is green. If you don't know that about Texas, you think of the TV show Dallas and big oil money. This is green electricity in Texas too. So it's if you believe in the green energy transition and global warming, then it's a plus. It should be something that even people that are worried about electricity production and CO2 emissions should be supporting. So, hey, that's a cool thing. It's looking like a doom and gloom article. They're forecasting that, Texas is going to have an energy shortage, and that they'll either have brownouts, blackouts, or electricity will just get really expensive. But this is something Bitcoin fixes. And you can thank Pierre Rochard, et cetera, and all the other Bitcoin miners in Texas for helping stabilize your electricity grid. All right. I have been yammering for long enough, way longer than I anticipated it would. I think talking over an hour now, and I was trying to keep this whole episode to right about an hour. So let's get to the reason why we're here on Wednesday. We're here because every Wednesday is DCA Wednesday. And if you don't know what DCA is short for dollar cost averaging. And dollar cost averaging is an investment strategy where you invest your money in equal portions at regular intervals, regardless of price. For example, this is going to be stack number 145. We started stacking all the way back on Wednesday, July 28th, 2021, kind of in the middle of the last halving cycle bull run between the two tops, the double peak. So far, we've stacked 144 times for we've converted a total of $2,880, including about $65 in fees, into a stack of 9,244,905 Satoshis. We've done that at an average purchase price of $31,152.29, because even though we bought during the last bull market, we bought all the way up to as high as $65,969. We paid more than that recently, but in 2021 during the last cycle, we bought all the way up to the all-time high, and then we bought all the way down to the cycle low, buying as inexpensively as $16,469.03 per Bitcoin. And that averages out to an average cost basis of $31,152.29. And we're going to add to that stack today. As usual, I'm going to use the handy dandy Cash App to do so. Cash App is not a sponsor of the show. They're not actually even the cheapest way to stack Bitcoin, but for small amounts like $20, I think it's the ease and the fact that they'll let us transfer that Bitcoin to cold storage without charging us a mining fee kind of makes up for the fees, the increased fees we're going to pay by stacking with Cash App. But this is a you do you thing. Obviously, pick a brokerage or well, first of all, pick one that's available where you're at, because most of the countries you're listening to, besides the United States, Cash App isn't even available. And there are other services, like I believe Strike is now available in Europe. Is it? I think so. I might be getting ahead of myself here, but pick a service that you feel comfortable using. You do your own research on this one. We're going to use Cash App. And I already have $20 on the Cash App because somebody reimbursed me for something I purchased the other day. So it's just a matter of tapping on Bitcoin, tapping buy, entering $20, tapping confirm, and boom! Just like that, we purchased another 33,755 sats. That is more than 3,200 sats more than we purchased just last Wednesday, because Bitcoin is on sale. That makes me happy. We ended up purchasing at a base price of $57,918. So about where we were when we started this episode. That is going to raise our total stack up to 9,278,660 sats, getting closer to my kind of unofficial goal of 10 million sats. If Bitcoin stays cheap, maybe we'll get there this year. If Bitcoin, I was worried when Bitcoin was 75,000, heading to 80,000 and higher, maybe that we would be getting so few sats per dollar that only stacking $20 of the Bitcoin at a time that we might not hit 10 million sats anytime soon. And that wasn't my original stacking goal for this podcast, but you'll find the longer you've been in Bitcoin that your stacking goal tends to move. You'll achieve your first goal, and then you'll set a new one. Right now, our goal is 10 million sats, and we're getting close. We got 9.2 million sats. And we raised our average purchase price, our average cost basis, by about $100. Our average cost basis is now $31,254.51. Still a heck of a lot cheaper than the $57,918 we purchased at. And even if we don't stack another single Satoshi ever, and Bitcoin goes to the moon, well, if Bitcoin just breaks 100,000, our stack will be worth $9,278.66. When Bitcoin eventually hits 1 million, that stack will be worth $92,786.60. And that is not too shabby for just $2,900 US, stacked at just $20 a week. Folks, plebs, that is why I started the DCA Wednesday series. It's why I chose weekly and why I chose just $20, because for most of you listening out there, if you're in the United States and Europe, $20 might not seem like a lot of money, but there are people out there listening that might even have trouble stacking $20. So I wanted to pick an amount that most people listening could reasonably afford to stack on a weekly basis. And I wanted to show that even stacking just $20 with a fiat weekly would add up to a potentially life-changing amount of fiat equivalent, life-changing amount of Bitcoin. You know, when Bitcoin becomes the global reserve currency, or when Bitcoin becomes at least on par with gold, that it's that maybe not everyone's using it in the entire world. There's still countries that are going to make you use their currency, because like North Korea and Cuba, there's No way they're ever going to make Bitcoin their official currency unless there's radical change to those countries. And who knows, I'm optimistic that could happen. But it wouldn't be unusual to think there will be some dictator somewhere that will make you, somehow, that will make you use a worthless fiat currency, that not everyone in the world will be using Bitcoin until we achieve utopia, I guess. But either way, at some point in time in the sooner rather than later future, Bitcoin will be more of a global reserve currency. And when it does, if you've been stacking with us, I don't think there are too many people that would be able to argue that, even $9,278 when Bitcoin takes 100,000 is a lot more money than the average American even has in savings. We hear repeatedly how the average person can't even cover a $500 emergency, that the average American has less than $400 in savings. And if you've been stacking with us, you already have more than $4,000 of the Bitcoin. And when Bitcoin hits $1 million, you'll have $92,000 worth of Bitcoin. And that is significantly more than the average American and probably the average pleb anywhere in the world has put away for a rainy day. Maybe not generational wealth yet, but we're going to keep stacking as well. Hopefully we'll get to that 10 million sat mark and beyond. And if Bitcoin stays on sale, if Bitcoin goes sideways throughout the summer, that would be fantastic. It'll help us get there sooner. So if you're worried about the price, if you've been staring at your Bitcoin stack and you've been doing the fiat math in your head and you're saying, well, look at how rich I am, and then you saw a big chunk of that evaporate, that pretend paper money, unrealized gains evaporate in your head, the way you should be looking at that is you're not done stacking, and your stack is going to be bigger, faster, the more Bitcoin's price stays depressed. So bring on that $44,000 Bitcoin that Dr. Jeff Ross was saying was even a possibility before the bull run really kicks off in earnest later this fall. That is enough for today, because I think I've been talking about an hour and 15 minutes already at this point in time. So I'm going to let you go and get on with your day. But before I do, I want to ask you to help support the podcast. We already mentioned you can do that by listening on Podcasting 2.0 and either streaming sats or sending us a boost. But the other way you can do so is by making sure that you leave a review of this podcast. Depending on what platform you're listening on, make sure you have automatic downloads or enabled, or that you're subscribed. You can also help support the podcast by making sure you follow us on Twitter. On Twitter, I am at BTC Bulletin Pod. And by helping increase the number of followers we have on Twitter, you'll help more people see our tweets. More people might find out about this podcast and start to listen. And that will help not only Orange Pill people, but will help us grow the podcast. And you can do that for free. Another way you can help support the podcast financially is if you like the idea of using Cash App or Strike, or even the Fold card. We have links in the show notes. If you just scroll down, you'll see referral links. None of those services are sponsors of the podcast. Everybody who uses those services has a referral code. If you use ours, they all have some sort of offer where you'll get like $5 or 10,000 or 20,000 Satoshis, depending on the service and the offer. Something you'll get for free, just for signing up for a service you might want to use already anyway. And for example, if you sign up for Cash App, you'll get $5 free, and the podcast will get $5 free. So you'll actually get paid to tip the podcast. I'll immediately turn those sats, that $5 into sats. Hopefully, you do the same. So you'll get a couple thousand sats just for free, and you'll help support the podcast in doing so. Either way, I also like to hear from you. So you don't have to send a boost. You don't have to stream us any of your valuable Satoshis to say hi. You can DM me on Twitter. Let me know what you think about the podcast. If you don't have Twitter, we're on Nostr. Our NPub is in the show notes as well. And if you have neither Twitter nor Nostr, you can send me a good old-fashioned email. The email address is bitcoinbulletin@protonmail.com. I try to check that at least daily, and I do like to hear what you have to say. Either way, don't forget to join us next Wednesday and every Wednesday while we grow that stack of Satoshis together, just 20 US fiat dollars at a time. Either way, though, keep on stacking those sats, you sexy sat stackers.